Somewhere tonight, a fisherman in Lagos, Naira, is selling tuna in Naira. A trucker in Jakarta is paying for diesel in rupiah. A shop owner in Lima is counting souls. None of them work for an American company. None of them have ever set foot in the United States. And yet, by the end of the week, every single one of those transactions will quietly touch a currency none of them control, the dollar. Not because they chose it, because the world built itself around it decades ago and never really built an exit. Here's the uncomfortable part. The United States produces about a quarter of the world's economic output, but its currency handles more than half of the world's trade invoices, more than half of the world's reserves, and roughly 9 out of every 10 foreign exchange trades on Earth. That gap between what the America actually makes and what its money actually controls is the whole story, and it's bigger than most people realize and stranger than most people are told. This video is about that gap, about how one country's currency became the operating system for the entire global economy, about the math that keeps it running, and about the cracks that are starting very quietly to show. Let's talk about why this matters right now, in 2026, not as history, but as something live. In 2022, the United States and its allies did something that had never been done at this scale. They froze roughly $300 billion belonging to a sovereign nation's central bank, not a company, not an oligarch's yacht, the actual reserves of the Russian state, sitting mostly in European institutions, simply switched off, frozen, untouchable. Years later, that money is still locked up, and Western governments are now arguing over how to use the interest it generates to fund Ukraine's defense without technically calling it confiscation, because calling it confiscation would terrify every other country holding dollars and euros. Every central banker on the planet watched that happen, and every central banker quietly asked the same question. If it happened to Russia, could it happen to us? That single event did more to fuel de-dollarization headlines than a decade of BRICS summits combined. China started settling more oil trades in yuan. India and the UAE began testing local currency payment corridors. Central banks from Beijing to New Delhi started buying gold at the fastest pace in decades. It looked, for a moment, like the beginning of the end. So here's the actual number, the one that rarely makes it into the panic headlines. As of the most recent IMF data, the dollar still makes up roughly 57% of all global foreign exchange reserves, down from over 70% at the start of this century, yes, but still more than the next 4 currencies combined. Down does not mean dead. A patient losing weight slowly is not the same as a patient dying, and right now, the dollar is still, by a wide margin, the patient everyone keeps betting on, which raises the real question this video is built around. If the dollar is just paper, backed by nothing tangible since 1971, why does the entire planet still organize itself around it? And what happens if that ever stops being true? To answer that, we have to go back to a hotel in New Hampshire in the summer of 1944. World War II hadn't even ended yet, but the Allied powers already knew the post-war world would need new financial plumbing. Delegates from 44 countries gathered at Bretton Woods and agreed on something simple on paper. Every currency would be pegged to the dollar, and the dollar alone would be pegged to gold at $35 an ounce. The dollar became the only currency in the world directly convertible into a physical, finite metal. Everyone else's money was now indirectly a claim on America's gold vault in Fort Knox. It worked beautifully for a while because it had to. The U.S. held most of the world's gold reserves after the war. Europe and Japan were rebuilding from rubble. There simply wasn't another option sitting on the table. But here's the part that almost nobody flags as the actual time bomb. To supply the world with enough dollars to rebuild and trade, America had to run deficits, had to ship more dollars overseas than it brought back. Individual countries needed dollars to function. America had to print them to keep up. An economist named Robert Triffin pointed out the obvious contradiction in the early 60s. The more dollars you print to satisfy global demand, the less those dollars are actually backed by your shrinking gold reserves. Confidence and supply were pulling in opposite directions. Nobody fixed it. They just kept printing and hoped the math wouldn't catch up too fast. By 1971, it caught up. Foreign governments, watching the U.S. print money to fund both a war in Vietnam and a growing welfare state, started doing exactly what the gold-backed system promised they could do. They showed up and asked for their gold back. France reportedly literally sent a warship to collect it. Fort Knox was draining. So, on a Sunday night in August 1971, President Nixon went on television and in about 9 minutes ended the entire system. The dollar would no longer convert to gold.
full stop. No vote at Bretton Woods, no replacement plan announced, just effectively, we're done. Economists still call this the Nixon Shock, and the name fits because it should have shocked the dollar to death. A currency unpegged from anything physical, backed by nothing but a promise from a government that had just broken its previous promise. By every textbook rule, the rest of the world should have walked away. It didn't, and the reason it didn't is the part of this story that actually explains everything that came after. In 1974, 3 years after Nixon ended the gold standard, U.S. officials flew to Saudi Arabia and struck a quiet deal that never needed a dramatic press conference. Saudi Arabia would price its oil exclusively in dollars. In return, the United States would offer military protection and advanced weapons sales. Other OPEC members fell in line shortly after. Think about what that actually did. Oil is the one commodity every economy on Earth needs, regardless of ideology, regardless of politics. If you want oil, and oil is priced in dollars, you now need dollars, no matter who you are or where you are. Suddenly, the dollar wasn't backed by gold anymore. It was backed by something arguably more durable, the literal energy that keeps the global economy moving. They call this the petrodollar system, and it quietly rebuilt the foundation Nixon had just kicked out. From there, the machine kept compounding. Oil-exporting nations took their dollar earnings and parked them in U.S. Treasury bonds, the safest, deepest, most liquid debt market on the planet. That created what's known as the euro-dollar market, dollars circulating and being lent entirely outside the United States, used by banks in London, Singapore, and Frankfurt, with zero need to ever touch American soil. Today, an estimated 80 to 90% of global trade invoices and the overwhelming majority of cross-border bank lending still happen in dollars, even between two countries that have nothing to do with America. A company in Brazil selling soybeans to a buyer in Vietnam will more often than not settle that deal in dollars because the dollar market is the deepest, most liquid, most predictable pool of money on Earth. Nobody picked the dollar out of patriotism. They picked it because it's the path of least resistance, and least resistance over 50 years becomes structural dependence. Now here's the uncomfortable math nobody puts on a slide at a finance conference. The system only works because the rest of the world is willing to lend America almost unlimited amounts of money in America's own currency at relatively low interest rates forever. Economists call this America's exorbitant privilege, a phrase coined decades ago by a French finance minister who was, not coincidentally, annoyed about it. The U.S. can run up debt, pay for wars, fund tax cuts, bail out banks, all by issuing more treasury bonds because the rest of the planet treats those bonds as the closest thing to a risk-free asset in existence. As of mid-2026, total U.S. national debt has crossed $39 trillion. The country is now paying more than $1 trillion a year just in interest on that debt, more than it spends on the military, more than it spends on most entitlement programs individually. Debt relative to the size of the entire economy sits above 120%, and the government adds roughly $7 to $8 billion of new debt every single day. Normally, a country racking up numbers like that would see its currency punished. Investors would flee. Interest rates would spike to compensate for the risk. That's what happens to Argentina. That's what happens to Turkey. It is, conspicuously, not what has been happening to the United States, at least not yet. Because when global markets get nervous, when there's a war, a crash, a pandemic, money doesn't run away from the dollar, it runs toward it. Economists call this flight to safety, and the irony is almost poetic. The country causing global anxiety with its debt is also the place everyone runs to for safety when that anxiety hits. This is the exorbitant privilege in its purest form. America's debt isn't just America's problem. It functions as the entire world's savings account,
which means the rest of the world has an enormous, often unspoken incentive to keep that account healthy, because if it ever genuinely failed, the damage wouldn't stay contained inside U.S. borders. It would rip through every pension fund, every central bank reserve, every insurance company balance sheet on the planet that's holding treasury bonds, which is to say, almost all of them. So let's hold the hype up against the reality, side by side, because the gap between the two tells you almost everything about where this is actually headed. The hype says the dollar is dying, that BRICS nations are building a gold-backed alternative, that de-dollarization is accelerating by the month, that the empire is collapsing in real time on social media threads with dramatic charts. The reality is slower and far less cinematic. Yes, the dollar's reserve share has slipped from 71% in 2001 to roughly 57% today. That's
That's real. But most of that decline didn't go to a rival superpower currency. It went to a basket of smaller currencies: the Australian dollar, the Canadian dollar, gold itself. Central banks simply diversifying risk rather than picking a new champion. The Chinese yuan, despite endless headlines about its rise, still sits at under 2% of global reserves. 2% after more than a decade of deliberate Chinese effort to internationalize it. China's own capital controls are the biggest obstacle here, ironically self-imposed. You cannot become the world's reserve currency while also restricting how freely money can move in and out of your borders, because the entire appeal of a reserve currency is that people trust they can get their money out whenever they want. China wants global trust and domestic control simultaneously. So far, it can't have both. There is no liquid, trusted, politically neutral alternative sitting on the bench, ready to take over. Not the euro, fractured across 19 different national treasuries with no single bond market to match U.S. treasuries. Not the yuan, restricted by capital controls and an opaque legal system foreign investors don't fully trust. Not gold, which is real, finite, and completely incapable of settling the trillions of dollars in daily transactions a modern economy requires. De-dollarization isn't a myth. It's just running at the speed of a glacier, not an avalanche. And glaciers make for terrible headlines, but accurate forecasts. So zoom out, because this is bigger than currency trivia. This is about leverage, and leverage is never just financial, because the dollar system runs through American-controlled infrastructure, primarily the SWIFT messaging network and U.S. correspondent banks. Washington effectively holds a switch that can cut almost any country off from global trade. That's not theoretical. It's already been used against Iran, against North Korea, and now against Russia. Every time that switch gets used, even legitimately, even against a country most of the world agrees deserved it, it sends the same quiet signal to every other government on Earth, including ones that consider themselves American allies. Your reserves, your saving, your trade are only as safe as your relationship with Washington stays friendly. That single realization is the actual engine behind every de-dollarization effort happening right now. Far more than ideology or rivalry, it's risk management. Countries are starting to treat dollar exposure the way you'd treat keeping all your savings in one bank that's also your landlord, your boss, and occasionally your judge. And here's the part that should genuinely unsettle people who think this is purely an American story. If trust in the dollar ever eroded meaningfully, faster than the next system could absorb the shock, it wouldn't be a slow, manageable transition. It would look more like a stampede, the same instinct that makes investors flee in a panic just turned inward on the dollar itself. Interest rates on U.S. debt would spike. The cost of servicing $39 trillion would explode overnight, and the country that built its entire economic identity as being the world's safe harbor would suddenly need a safe harbor of its own, with nowhere obvious left to go. Nobody actually wants that outcome. Not China, not Russia, not the Gulf states sitting on enormous dollar reserves. A dollar collapse wouldn't be a victory for anyone. It would be closer to global cardiac arrest, and everyone holding dollar assets, which is to say almost every major economy on the planet, would be standing in the wreckage together. That mutual dependency, more than any treaty, military alliance, or trade agreement, might be the actual thing holding the current system together, not love for the dollar, fear of what replaces it if it breaks too fast. So where does that leave us? The dollar isn't ruling the world because it's beautifully designed, or because some council of economists decided it deserved the job. It's ruling the world because 50 years after it was unpegged from anything physical, nobody has built anything better, faster, or more trusted to take its place. It survives less on strength and more on the absence of a credible alternative, which is a strange, almost accidental kind of power, built on inertia, reinforced by self-interest, held together by the simple, uncomfortable fact that almost everyone holding dollars needs the dollar to keep working, even the countries that resent needing it. But inertia isn't permanence. Empires built on currency have collapsed before. The British pound ruled global trade for a century before quietly, almost embarrassingly, handing the role to the dollar after 2 world wars and an empire it could no longer afford to run. Nobody in 1920 thought that handover was coming either. So maybe the real question isn't whether the dollar falls. History suggests every reserve currency eventually does. The real question is whether the next system, whatever it ends up being, gets built deliberately with the world's input, or whether it gets built the way this one did, quietly, reacting reactively, by accident, out of whatever's left after the next crisis nobody saw coming. And if that's how it happens again, the only honest question left is simple. Who do you trust to hold that much power next?